welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio, we have Phil Mackintosh, Chief Economist at Nasdaq, for instant reaction on the Fed's interest rate hike and some of the messaging we're getting from Jay Powell. And Phil, it kind of goes in line with some of the charts we're going to take a look at. The market clearly digesting it well, as he's saying there's no incentive or reason to over-tighten.
Yeah, but at the same time, he's also done what everybody thought he was going to do today. So, we sort of think about what happened last year. Inflation was high when we started the year, and it just got higher. And so we've been through this year of rapidly raising rates. We've now seen for the last 6 months, inflation's been coming down. It's still higher than where interest rates are now, so we still have a negative real interest rate. But what we're seeing is the pace of rate hikes is slowing, and the market thinks we're going to stop at about 5%. I know the Fed's talking about maybe getting to 5.25, but either way, we're pretty close to the end, which is good news.
Yeah, so if we take a look at the next chart here, it looks as if the market is expecting we're kind of like peak rates are really close to it.
Yeah, I mean, you can see even going back into October, the market sort of was looking forward and thinking by the time we get to 5, that's probably going to be enough. Inflation was expected to be coming down pretty quickly, and it is. And so I think halfway through this year, if you look at the futures curve, we're expecting maybe the Fed will have to start reducing rates if the economy slows down. I know the Fed doesn't think that's going to happen, and there's a couple of good reasons why that might be the case. Unemployment's still really strong, but basically 5% looks like it's going to be the peak, and it has looked that way for months. And with that, the bond market volatility has slowed right down too.
Right, so then what's the Fed really focused on here moving forward?
Well, obviously the Fed's worried about inflation and employment. That's their two main goals. And if they're just looking at those data points, inflation, as we said, is coming down. Employment is still at like multi-decade lows at 3.5%, but there's some numbers that seem to indicate there's a slowdown. So if you look at wages, they've slowed down how quickly they're growing. If you look at hiring of temporary workers, that's slowed down. And so there's a few indicators that even the employment situation is starting to loosen down. And that'll be good news for the Fed because they won't need to keep hiking past this 5% level.
They keep saying inflation's coming down, but I still feel like things are as expensive as they ever were. Is it because energy's come down, housing's come down, rents have come down? Do they have such a weighting on it?
Yeah, so housing is a huge component, and actually the housing is what's pushing the inflation number up at the moment, because on a rolling 12-month basis, the sort of COVID spike in housing prices caused by low interest rates is still baked into house prices. But we've had 5 months now of house prices falling, and so eventually that will actually become deflationary. Rents have started to weaken, so that whole component, which is still holding inflation up, will actually start to pull inflation down, just like oil has been the last few weeks. So if you think about the gas prices, remember a year ago we were talking about $5 gas. It's way cheaper than that now, and no one thinks about that because we're now worried about our egg prices, and our orange juice prices. But the reality is there's a couple of components in the inflation that are actually deflationary. Things are cheaper than they were 12 months ago. It's just the services inflation's a little bit slower. And remember when we sort of came out of COVID, everyone spent on products because we're still at home, and then we got vaccinated and we started spending on services. So the manufacturing sector inflation is falling very quickly. It's the services sector that's kind of still holding up. Wages are sort of holding that up a bit as well.
I guess what makes it hard for me to wrap my head around this is people shop for eggs and chicken every week. They don't buy houses every week, right?
That's part of the problem.
So the strength of the consumer is quite impressive stuff. I just feel like things are so much more expensive. Certainly getting less for your money is, what's it called with the packaging, like package
shrinkflation.
Shrinkflation.
Yeah.
So you see that, and then Phil, I mean, do you really, it's almost like when we were talking about wages being transitory. With the price increases that we've seen, so the consumer packaged good companies can maintain their margins and make shareholders happy, do you think they're really going to decrease prices? I mean,
well, it's starting to happen. So you're seeing margins are actually starting to come down. A lot of the forecasts for earnings are actually for earnings to fall. And so it's starting to build in. There's almost no supply chain bottleneck problems left, except for in chips, which is affecting the car sector. But a lot of the other supply chains like freight, so container rates are right back down to where they were pre-COVID. So a lot of the inflation effects for COVID have come out of the economy. It's just, to your point, it's like I'm buying eggs every week, I feel it. I don't buy a house every week. And so in our head, we feel like there's inflation now. It's actually coming down though.
Well, let's hope it comes down some more, Phil.
That's what the Fed wants too.
There you go. All right. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.